Something happened on June 9th, 2024, something so quiet, so subtle, and so buried beneath ordinary news cycles that most of the world never even noticed. Yet the impact of this single event will shape global finance for the next 50 years. There were no press conferences to warn the public, no dramatic headlines rolling across screens, and certainly no panic in global markets. Instead, a simple, almost bureaucratic announcement slipped out of Riyadh, ignored by most mainstream outlets. On that day, Saudi Arabia allowed its 50-year petrodollar agreement with the United States to expire. No renegotiation, no extension, not even an official explanation. One of the most powerful financial structures of the post-war world simply reached its deadline and vanished. If you're unsure why this matters, you're not alone. Most people have never even heard the term petrodollar system, let alone understood its influence. But once you see how deeply this arrangement shaped global power, you'll understand why its expiration is far more significant than any market headline, political speech, or economic forecast you've heard this year. What just ended was not simply a contract about oil, it was the underlying architecture of American financial dominance, and that architecture has now cracked in a way it cannot be repaired. To understand the scale of this shift, we need to revisit what the petrodollar system actually was, because most explanations gloss over the parts that made it so important. After the oil crisis and the collapse of Bretton Woods in the early 1970s, the United States faced a world where the dollar was losing stability, gold backing was gone, inflation was rising, confidence was shaky. In 1974, the US reached a strategic deal with Saudi Arabia, the world's largest oil exporter and the unofficial leader of OPEC. The terms appeared simple, yet the consequences were enormous. Saudi Arabia agreed to sell all its oil exclusively in US dollars, no matter who the buyer was. On top of that, Saudi Arabia would reinvest its surplus oil revenues into US Treasury bonds. In return, the United States would provide military protection and weapons support for the Saudi kingdom. What this meant in practice was that every country on earth suddenly needed US dollars because every country needed oil. Even nations with no interest in US goods or investments still had to accumulate dollars purely to keep their energy systems running. The chain reaction this created transformed the global economy. When Japan or Germany wanted to buy oil, they first had to exchange their own currency for US dollars, increasing dollar demand and strengthening its value. Once they used those dollars to pay Saudi Arabia, the Saudis would then reinvest the money into US government bonds. That meant the dollars flowed right back into American financial markets, financing US government spending at very low interest rates. It was an elegant loop. Foreign nations needed dollars, those dollars went to oil exporters. Oil exporters invested them in US debt, and the US used that money to fund everything from domestic programs to global military operations, including protecting Saudi Arabia, the key player in the system. This cycle allowed the United States to run deficits that would have collapsed any other currency. It enabled the US to consume more than it produced, borrow more than it saved, and build military power far beyond what its domestic economy alone could support. All because oil, the lifeblood of the modern world, was priced exclusively in dollars. But that world no longer exists. On June 9th, 2024, the obligation for oil sales to be priced in dollars ended. Saudi Arabia can now sell oil in yuan, euros, yen, or any other currency buyers prefer. The dollar hasn't disappeared, but it has lost its privileged, mandatory status. Optionality changes everything. The shift wasn't theoretical, it had immediate consequences. Within 72 hours of the agreement expiring, three of America's largest banks, JP Morgan, Bank of America, and Citigroup, quietly adjusted their balance sheets. These were not typical portfolio adjustments. JP Morgan reduced its dollar-denominated emerging market exposure by $8.4 billion. Bank of America shifted $6.2 billion from dollar reserves into a diversified currency mix including yuan and euros. Citigroup updated risk models to treat dollar-based assets as higher risk than before. None of these banks made announcements. There were no interviews, no investor warnings, no media commentary, but the regulatory filings told the real story. These institutions understood the implications of the petrodollar's end before anyone else and repositioned themselves instantly. Why the silence? Because if any major bank openly warned about dollar vulnerability, it would accelerate the very crisis they're preparing for. Public statements from institutions of that scale would spark panic, trigger capital flight, devalue the dollar, and inflict massive losses on their existing positions. So they move quietly, strategically, and without public explanation because their survival depends on it. This is how financial crises actually begin. The informed players shift early and silently. The uninformed public reacts only after the damage becomes visible. By the time ordinary investors realize what's happening, the institutions have already moved, and the consequences fall on those who waited too long. Right now, we're in the early phase of that process. The informed money is repositioning. The only question is whether ordinary people will recognize what's happening soon enough to protect themselves. The banks moved quickly because they understood something most people still don't realize. The petrodollar system created between $600 and $800 billion of artificial demand for US currency every single year. This wasn't demand based on American innovation, productivity, or economic performance. It was demand created solely because oil had to be bought in dollars. The strength of the dollar wasn't only a reflection of the US economy, it was a reflection of a system that forced every nation to use the dollar whether they wanted to or not. Now that the system is gone, that artificial demand will begin to fade. Not instantly, not in a dramatic collapse, but gradually, persistently, and permanently as new contracts and new energy partnerships emerge using currencies other than the dollar. Existing oil contracts still operate in dollars, and financial infrastructure built around the dollar doesn't disappear overnight. But each new agreement, each new trading route, each new partnership now has freedom that didn't exist before. And countries will use that freedom. In fact, they already have. Less than a month after the agreement expired, Saudi Arabia completed its first oil sale to China, priced in yuan instead of dollars. The transaction wasn't massive, 48,000 barrels per day over a one-year period, but it was symbolic in a way markets cannot ignore. It marked the first time the world's largest oil exporter formally priced oil in a currency other than the dollar. Russia has already moved much further. Because of Western sanctions following the Ukraine conflict, Russia now prices around 70% of its oil and gas exports in non-dollar currencies. Sales to China are done in yuan. Sales to India use rupees or yuan. And sales to friendly countries often avoid the dollar entirely using currency swaps or barter systems. Iran, facing decades of sanctions, has also developed complex methods to sell oil without touching the dollar using gold, cryptocurrencies, yuan, and multi-layered swaps that bypass US financial networks. Even the United Arab Emirates, long aligned with Western markets, has begun offering yuan-denominated oil futures, creating new infrastructure for non-dollar energy trading that didn't even exist 2 years ago. This pattern isn't random. It's not ideological. It's strategic. Every major energy producer that feels even slight pressure from the US financial system is now actively building alternatives. And even those that are not pressured are creating options simply because they do not want their entire economy dependent on a single foreign currency. This is the domino effect that started the moment Saudi Arabia let the petrodollar agreement expire. Their decision didn't just change their own trading practices, it legitimized the idea that oil does not need to be priced in dollars. For 50 years, countries feared the consequences of challenging the petrodollar. Now they see that shifting away from it isn't risky, it's normal. The result is visible in the numbers. In 2023, 87% of global oil trades were settled in dollars. By mid-2024, the figure had fallen to 81%. By early 2025, it hit 76%. This decline isn't slowing down, it's accelerating. Every 1% drop in dollar-denominated oil transactions removes roughly $40 to $50 billion in annual demand for the currency. We are literally watching hundreds of billions of dollars in global demand evaporate in real time. But the story doesn't end with oil. The petrodollar system shaped every major part of global finance. When countries were forced to hold dollars to buy energy, they used those same dollars for other needs. They invoiced international trade in dollars, stored reserves in dollars, and borrowed in dollars, all because they already had dollar liquidity built around the energy system. As the foundation collapses, everything built on top of it begins to shift as well. The clearest evidence is in global central bank reserve data. In 1999, the dollar made up 71% of global reserves. By 2024, that number had dropped to 58%. That's a staggering historical decline. But what matters most is the speed. Between 1999 and 2015, dollar reserves fell slowly from 71% to 64%, a mild 7-point drop over 16 years. But between 2015 and 2024, reserves fell from 64% to 58%, a 6-point drop in just 9 years. And the decline is speeding up. Central banks are no longer assuming the dollar's dominance will last forever. They're diversifying now, quietly, cautiously, and deliberately. Where is the money going? Not into one new currency, but into many. The euro has gained slightly, reaching about 21% of global reserves. The Chinese yuan has gone from nearly non-existent to 3% small in appearance, but massive in growth rate, considering it was irrelevant 10 years ago. Gold holdings are rising. Commodity-backed assets are increasing. Even small currencies like the Australian and Canadian dollars have grown their share. And for the first time ever, some central banks are holding cryptocurrency exposure, not because they trust crypto, but because they don't fully trust the dollar. This diversification reflects a fundamental shift in global strategy. Nations no longer believe that relying on a single reserve currency is safe. They are building resilience against dollar volatility, and that very process contributes to the dollar's weakening, creating a feedback loop that accelerates the transition. When the world stops believing the dollar is unshakable, it becomes shakeable. The consequences for US government financing are immediate and severe. The United States runs an annual federal budget deficit of around $1.8 trillion. That deficit must be financed by selling Treasury bonds. For decades, foreign nations, especially oil exporters, recycling petrodollars, bought huge amounts of US debt, keeping yields low and borrowing costs manageable. But as the petrodollar cycle breaks, foreign demand for treasuries is falling. In 2021, foreign holdings peaked at $7.7 trillion. By early 2025, they had dropped to $7.2 trillion. China alone reduced its holdings by $340 billion. Saudi Arabia cut $37 billion. Even Japan, America's most dependable foreign buyer, reduced holdings by $85 billion. This sets up a dangerous financial spiral. The US government needs to sell more debt because deficits keep rising. Foreign buyers are purchasing less. Domestic buyers must absorb the difference, but only if yields rise high enough to compensate for the risk. Higher yields mean higher interest costs. Higher interest costs increase deficits. Higher deficits require issuing even more debt. The cycle feeds itself. We can already see the effects. The yield on the 10-year Treasury rose from 1.5% in 2020 to around 4.3% by early 2025. That rise translates into enormous additional costs. Every 1% increase in average yields adds roughly $350 billion per year to federal interest payments. The Congressional Budget Office projects that by 2034, interest payments will exceed $1.6 trillion annually, becoming the single largest expense in the federal budget, larger than Social Security or defense. Those projections were made before the petrodollar ended. The real numbers will almost certainly be worse. And this isn't just a government problem, it will touch everyone. When the dollar weakens, imports become more expensive. The US imports about $3.5 trillion worth of goods and services each year. A 10% drop in the dollar's value adds roughly $350 billion in extra costs. That means higher prices on shelves, weaker purchasing power, and lower living standards. These rising costs don't fall evenly across society. Wealthy Americans who hold large portfolios of stocks, real estate, and commodities often see their assets rise in nominal terms as the dollar weakens. Their wealth adjusts upward with inflation. But working-class Americans, whose savings usually sit in cash, bank accounts, or fixed-income instruments, experience something very different. Their purchasing power drops and the value of their savings erodes. This is a silent form of taxation monetary devaluation that requires no vote in Congress and no public debate. It quietly reduces the buying power of millions of people, especially those least able to shield themselves. Inflation has already shown how painful this can be. Consumer price inflation reached 6.8% in 2024, the highest level in more than 4 decades. Food prices jumped 9.3%. Energy costs rose 12.7%. Housing climbed 8.4%. And all of this happened while the Federal Reserve was actively raising interest rates in an attempt to cool the economy. Now imagine what happens as the dollar continues to weaken because global demand is falling. Import costs rise, production costs increase, and wages fail to keep up. The gap between what households earn and what they must spend widens. Everyday life becomes harder. Stress grows. And when financial pressure builds for too long, political instability follows. This pattern is not hypothetical, it has played out repeatedly in countries experiencing currency decline throughout modern history. But the most concerning part of this transition is not just the economic cost, it's the speed at which everything could change. Financial systems often appear stable until the very moment they are not. Confidence can erode slowly for years and then collapse in weeks. We saw this in 2008 when the subprime mortgage crisis went from a manageable problem to a global financial meltdown in less than 6 months. We saw it in 1997 when a single currency devaluation in Thailand triggered a chain reaction that swept across Asia in a matter of weeks. Markets behave predictably for long periods until they suddenly don't. This is the risk we now face. The global monetary system is weakening in several places at once. Dollar reserves are falling. Foreign treasury buying is declining. Alternative payment systems are being built. Oil contracts are shifting away from the dollar. Each trend on its own might be manageable. But when these trends converge, they create conditions for a confidence break, a moment when markets collectively realize the old system no longer works. The most likely trigger will be an announcement from a major sovereign bondholder. Imagine China, Japan, or Saudi Arabia announcing a significant reduction in their US Treasury reserves, framed as a routine diversification decision. On the surface, such a move might appear ordinary, but markets will interpret it as a signal. The world's major players no longer trust the long-term stability of the dollar. Other central banks will not wait. They will accelerate their own diversification to avoid holding assets that may soon fall in value. Once that happens, demand for US Treasuries drops sharply. Yields spike. The Federal Reserve faces an impossible choice. If it allows yields to rise, it risks crashing the economy as borrowing costs explode. Mortgages, business loans, government financing, everything becomes more expensive. If the Fed intervenes by printing money to suppress yields, it undermines the dollar further, triggering deeper currency decline. Either choice leads to crisis. The only question is which kind. Once confidence breaks, the feedback loops become extremely difficult to control. Falling treasury demand pushes yields higher. Higher yields increase government interest costs, worsening deficits. Worsening deficits require more bond issuance. More issuance pushes yields up again. At the same time, a weakening dollar raises import costs, fueling inflation. Inflation pressures the Fed to raise interest rates, which then worsen the debt spiral. These forces reinforce one another. This is why the major banks have already begun repositioning. They see the structural changes. They see the risk models. They see how vulnerable the system is once the petrodollar anchor disappears. And they know that by the time the public becomes aware, it will be too late to adjust positions without suffering enormous losses. Looking at their moves reveals how seriously they are taking this. JP Morgan increased its holdings of yuan-denominated assets by 34% after mid-2024. They expanded clearing operations with Chinese banks and built new currency swap systems, allowing clients to move between dollars and yuan without using traditional foreign exchange channels. These are not small adjustments, they are strategic hedges against a changing global order. Goldman Sachs produced internal research, not released to the public, projecting that the dollar's share of global reserves could fall to 45% by 2035. Their reasoning was direct. The end of the petrodollar removes the structural force that held dollar dominance in place, and diversification will speed up as alternative systems mature. Citigroup reshaped its emerging market portfolios, reducing dollar exposure from 76% to 64%, and raising yuan exposure from 8% to 17% in only 4 months, an unusually rapid shift at institutional scale. Bank of America updated its credit models to treat dollar-denominated emerging market debt as riskier than before, signaling internal expectations of increased volatility in dollar-linked assets. All these actions reflect one theme: Major institutions no longer see the dollar as unquestionably stable. They are preparing for a world where dollar dominance continues to weaken, and where assets linked to the dollar carry higher risk. And importantly, they are doing all of this quietly. The public isn't being warned. Shareholders aren't getting long explanations. The institutions are protecting themselves first. They must. If they openly stated their concerns, they would trigger the very crisis they are trying to avoid. This information gap, where insiders understand the risks and act early while the public stays unaware, has occurred in almost every major financial crisis. Those with access move first. Everyone else reacts later. This is why understanding what's happening now is so important. People need clarity on what this transition means and how it affects their own financial security. Not through fear or panic, but through awareness and preparation. Because the world's monetary system is shifting whether individuals notice or not. And in times of transition, those who understand the change early have options. Those who don't are forced to deal with the consequences. Whenever people hear about major monetary shifts, the first question they ask is always the same: what should I do? And while this video isn't financial advice, the logic behind the changes we're discussing points to clear principles anyone can understand. The first idea is simple. If the dollar is losing purchasing power because global demand for dollars is decreasing, then keeping all your savings in dollar-denominated bank accounts exposes you directly to that decline. When a currency weakens, the money sitting in savings accounts loses real value. That doesn't mean empty your accounts, it means understand the risk of concentration. Just as central banks diversify their reserves, individuals can diversify holdings across multiple currencies or assets that don't rely on dollar strength. That can take many forms. Accounts in foreign currencies, exposure to international markets, or assets whose value isn't tied to any single currency. The point isn't to predict which currency will rise, it's to avoid depending solely on one that's structurally weakening. The second principle involves understanding debt. If someone holds fixed-rate, dollar-denominated debt, like a mortgage, the weakening dollar can actually work in their favor. You borrow dollars today, repay them years later, but those future dollars may have lower purchasing power. In real terms, you're paying back less valuable money. Meanwhile, holding long-term dollar bonds does the opposite. You're paid back in weaker dollars while facing higher interest rate risk. This shift turns traditional assumptions upside down. What used to be considered low-risk savings instruments now carry currency exposure most people don't think about. The third principle is recognizing the value of assets that hold intrinsic value independent of currency systems. These include real estate, commodities, productive businesses, and certain types of infrastructure. Such assets don't rely on the strength of a specific currency. They generate value through utility, scarcity, or production, not through monetary policy. When currencies transition or weaken, these assets often maintain or increase their relative value. The fourth principle is understanding time. This transformation will not complete in months. The petrodollar system took 50 years to build, and unwinding it will take years of contracts expiring, trading relationships shifting, and new financial infrastructure emerging. That means the window to prepare is open, but not indefinitely. Each year, more energy transactions shift away from the dollar. Each year, more central banks diversify. Each year, more global institutions build alternatives to dollar systems. By recognizing the trend early, individuals gain flexibility that those reacting later won't have. The final principle is understanding scale. This isn't only about personal finances, it's about the restructuring of the global monetary order. Every major shift in reserve currencies throughout history, from the British pound losing dominance to the rise of the US dollar, has created winners and losers. Nations gain or lose power. Industries rise or fall. Individuals can preserve wealth or watch it erode, depending on whether they understand the shift. The banks have already acted. They aren't waiting for news anchors or government officials to confirm what's happening. They've seen the data, run the projections, and moved their positions accordingly. The question for individuals is whether to wait for the mainstream narrative to catch up or to pay attention to what institutions are doing now. And this brings us to the timeline. The petrodollar agreement expired in June 2024. We are now in early 2025. The changes we're discussing are not forecasts, they're already underway. Oil contracts have shifted. Treasury buying patterns have shifted. Reserve allocations have shifted. None of this is speculative. It's observable. But the full consequences will unfold over 5 to 10 years. That means the situation is not urgent in the sense of needing immediate, drastic action, but it is urgent in the sense that waiting until the final stages of the transition removes the ability to adapt thoughtfully. People always believe they'll have more time, but monetary transitions often move slowly for years and then rapidly at the end. Once confidence breaks, once the world collectively realizes the dollar system no longer holds change, accelerates at a pace that leaves almost no room to react. This is why understanding the broader picture is essential. We're not just witnessing the weakening of a currency, we're watching the end of a financial era. For half a century, the petrodollar system provided the United States with extraordinary advantages. It enabled cheap borrowing, the ability to sanction adversaries by restricting access to dollar systems, the capacity to run large trade deficits without triggering a currency collapse, and the ability to fund military power far beyond what domestic resources alone could support. All these advantages grew from dollar dominance, and dollar dominance grew largely from the fact that the world's most important commodity, oil, was priced exclusively in dollars. Once that cornerstone disappeared, the entire structure began to lose stability, not instantly and not completely, but inevitably. What replaces this system will not be a new singular empire currency. The era of one global reserve currency is ending. The world is moving toward a multipolar monetary framework, a system where dollars, euros, yuan, and perhaps other regional currencies share global reserve functions. No single currency will dominate the system the way the dollar did. And that lack of hierarchy brings new challenges. A multipolar currency world is less stable because there is no central authority capable of acting as a global lender of last resort. It is more susceptible to crises because different regions will operate under different currency zones. It is more fragmented because trade patterns will shift along geopolitical lines. The transition to such a system will be turbulent. Dollar-based obligations will need to be restructured, and some may even default. Asset prices will adjust to new currency realities. Markets built on the assumption of dollar permanence will need to redesign their models. Financial institutions with heavy dollar exposure will face losses. But eventually, after shocks, adjustments, and restructuring, a new equilibrium will appear. Global commerce will continue, just under different rules. The question isn't whether the system changes, it's how disruptive the transition becomes and who absorbs the cost. My hope is that giving people this information early can help them avoid being on the losing side of a shift that is already underway. Because neither the banks, nor the government, nor major media outlets are going to warn the public in advance. They never do. Only after the transition becomes undeniable will the explanations arrive. But by then, the positioning window will have closed. The first domino fell on June 9th, 2024, when Saudi Arabia quietly allowed the petrodollar agreement to expire, and everything since then has been part of an unfolding chain reaction. The system that anchored global finance for half a century is now dissolving, not suddenly, but steadily. And as the world adapts, individuals will have to decide whether they want to understand the transition early or be forced to confront it later when the consequences become unavoidable. The banks have already signaled their choice. The data shows they have acted reducing dollar exposure, increasing foreign currency holdings, building alternative clearing systems, and adjusting internal risk models, all without offering public explanations. Their silence is strategic. Institutions that depend on stability cannot openly discuss the structural weakness of the system they operate within, but their actions speak louder than any warning could. They are preparing for an era where the dollar is still important but no longer dominant, still widely used but no longer mandatory, still powerful but no longer unrivaled. Now the question is whether ordinary people will recognize what's happening before the effects begin shaping their daily lives, because the global monetary system is entering a phase where change accelerates. The more countries shift away from the dollar, the easier it becomes for others to do the same. The more reserves diversify, the faster the dollar's share declines. The more alternative payment networks develop, the weaker the old dollar-centered system becomes. Confidence is the force that held dollar dominance together. And confidence is the force that, once shaken, accelerates decline. As we move forward, the transition will become more visible. Nations will continue signing bilateral trade agreements using their own currencies. More oil contracts will be priced in yuan, euros, and other regional currencies. Central banks will keep diversifying their reserves. Global institutions will adjust their lending frameworks, and the dollar will slowly lose the structural privileges it enjoyed for 50 years. At first, these changes will appear technical, distant, and irrelevant to most people's daily concerns. But as the transition deepens, those effects will become personal. A weakening dollar doesn't just reshape global power, it reshapes household budgets. Higher import prices mean more expensive consumer goods. Rising interest costs mean higher taxes and reduced government services. Increased financial instability means markets become more volatile, affecting retirement accounts, pensions, and savings. Wealth disparity grows as those with real assets preserve value, while those with cash savings watch purchasing power erode. Political debates intensify as governments struggle to address rising living costs and shrinking fiscal space. The transition affects everything from groceries to mortgages, from public spending to personal security. This is why understanding what's happening now is critical. Not to create panic, but to build awareness. Not to predict doom, but to recognize structural change. Not to fear the future, but to prepare for it. Despite the challenges ahead, it's important to remember that the end of one system always marks the beginning of another. The world has gone through multiple monetary transitions, from the gold standard to Bretton Woods, from Bretton Woods to the petrodollar system. Each transition brought uncertainty, but also created new opportunities. The next era will be defined by a multipolar currency landscape. Dollars will remain significant, but they will be part of a broader global mix. Trade will flow across multiple currency networks. Financial influence will be distributed across several major economies. Regions will form stronger economic blocs. This distribution of monetary power may reduce some risks, but will introduce new ones. There will be no single stabilizing authority capable of responding to global crises, and that means local crises can spill across borders more easily. But over time, the world will adjust, and new frameworks will emerge to manage cross-border finance in this more diverse environment. For individuals, the most important thing is to stay informed, adaptable, and proactive. The petrodollar system shaped the world you grew up in, but the world your children will inherit will be built on different foundations. Recognizing that shift early means understanding where risks lie and where opportunities may appear. It means questioning assumptions that were once considered permanent. It means paying attention not only to what governments and institutions say, but to what they do. And it means accepting that the global economy is not static, it evolves. And those who understand its direction can navigate it more effectively than those who wait for clear signs long after the shift is underway. The end of the petrodollar is not the end of the world, it is the end of an era. And like every major historical transition, it will reward those who recognize change early and penalize those who assume nothing will ever shift. The silence surrounding this transition is not accidental. Governments avoid discussing it because acknowledging weakness in the currency would worsen the problem. Major banks remain quiet because public warnings would trigger the very crisis they are trying to avoid. Media outlets overlook it because the implications are complex and gradual, not easily captured in short headlines. But history rarely announces itself in real time. Most people only realize the transformation has occurred when they look back and see how much has changed. The petrodollar's expiration was not a dramatic event, but it marked a turning point that future generations may study as one of the most important monetary shifts of the 21st century. The cascade has begun. The institutions have moved. The system is changing. The only question now is what you will do with this information. Ignore it, fear it, or use it to prepare for the future that is already forming around us. Understanding the transition doesn't solve every challenge, but it gives you something far more powerful: clarity. And in a world where most people only wake up to reality once the damage is done, clarity is the most valuable asset you can have.